Ronald Reed, a janitor with no college education. What were his odds of getting rich? Practically zero. Yet when he died in 2014, he stunned the world with a net worth of over $8 million. How did that even happen? And more importantly, how can you achieve something similar? Well, that's exactly what the psychology of money will teach you by its end. Let's begin. Chapter 1. No one's crazy. Imagine two kids. One grows up during a recession, watching their parents lose jobs, stress over bills, and whisper at the dinner table about losing the house. And the other grows up during an economic boom, stocks going up, money flowing in, and vacations every summer. Now fast forward 20 years. Do you think those two people will see money in the same way? Do you think they'll view risk in the same way? Do you think they'll invest in the same way? Of course not. They lived through completely different realities. One learned to protect every dollar. The other learned to take bold risks. So, it's no surprise that what seems smart to one might seem insane to the other. Let's make it even more real. Have you ever wondered why some low-income people spend money on lottery tickets? From the outside, it seems foolish, but try to step into their shoes, just for once. Imagine living paycheck to paycheck. No vacations, no college savings for your kids. For them, buying a lottery ticket is the only moment they feel hope. That maybe, just maybe, life could be different. It's not just gambling, it's buying a dream. You might not agree with it, but when you see it that way, it completely makes sense. The truth is, no one's crazy. We're all just telling ourselves different stories about money, based on the lives we've lived. Think about it. Some people hoard, some spend fast, some fear debt, some ignore it, but it all makes sense when you know their backstory. And when you understand where someone's coming from, you don't just get better at managing money, you get better at understanding people, including yourself. So here's the big takeaway from this chapter. Everyone's financial decisions make sense to them, even if they don't make sense to others. We all carry different experiences, different scars, different dreams, and those shape every money choice we make. Chapter 2. Luck and Risk. Here's a truth most people don't like to admit. Success is never just a skill, and failure is never just a mistake. Behind the scenes, two invisible forces are always at work: luck and risk. In this chapter, we'll see how these invisible forces shape our financial lives, often in ways we don't even notice. And by the end, you'll never look at success or failure the same way again. Let's start with a story you probably haven't heard. We all know Bill Gates, right? Co-founder of Microsoft, one of the richest people on earth. He's a genius, right? But here's something surprising you might not know. In the 1960s, while most kids were scribbling on paper, Bill Gates was learning coding at school. That's right. His high school had a computer in the 1960s, long before most schools even heard of. He didn't build it. He didn't ask for it. It was just there. And so was he. Now imagine how rare that was. Out of hundreds of millions of high school students worldwide, only about 300 had access to a school with that kind of technology. And Bill Gates was one of them. And he used that access to explore, to learn, and eventually to start Microsoft. Was he brilliant? Definitely. Did he work hard? Absolutely. But would Microsoft have existed if he hadn't gotten that 1 in a million head start? Even Bill Gates admits, without that once-in-a-lifetime access, there's a good chance Microsoft never would have existed. So what's the lesson here? It's this: if we only copy what worked for others, without realizing how luck played a role, we might be chasing a blueprint that can't be replicated. Imagine two people start the same kind of business. Same timing, same effort, same everything. One becomes a huge success, the other goes bankrupt. From the outside, we usually say the successful one was a genius, and the one who failed made mistakes. But maybe the successful one got lucky. a big client, a surprise investor, and maybe the other one got hit with something totally unexpected, like an emergency or a health issue. Same initial decisions, but very different end results, all because of luck and risk. So when you win, don't let it go to your head. And when you lose, don't let it break your spirit. Sometimes it's not about what you did right or wrong. It's just luck or risk having its turn. So here's the big takeaway from this chapter. Be careful how you judge success, and even more careful how you judge failure, because what we often call smart might just be lucky, and what we call stupid might just be unlucky. And speaking of luck, in the next chapter, we'll meet two people who pushed their luck too far and paid the price. It's eye-opening. You don't want to miss it. Chapter 3. Never enough. Let's start with answering a simple question. Why is it so hard to feel like you have enough? Because as soon as you get more money, more status, or more success, you also start comparing yourself to people who have even more. And that comparison never ends. There's always someone above you. That's what this chapter is all about. The dangerous trap of always chasing more. Let's look at a true story. Rajat Gupta, born into poverty in India, rose to become the CEO of McKinsey, one of the most powerful consulting firms in the world. He worked hard, rose to the top. He climbed the ladder rung by rung, from dusty streets in India to sleek boardrooms in Manhattan. By his 50s, he flew first class, sat on company boards, shook hands with presidents. His net worth was over $100 million. He had respect, wealth, and influence, but surrounded by billionaires across the table, he still felt small. He wanted to be a billionaire, and he wanted it fast. So he passed along secret financial information to a friend at a hedge fund who used it to make millions. But soon, the truth came out. He was arrested, sent to prison, and lost everything. His career, reputation, legacy, gone. All for what? More than he needed, more than he could ever spend. And Gupta wasn't the only one. History is full of people who risked everything for just a little more. Take Bernie Madoff, for example. Before he was exposed as one of the biggest frauds in history, he was already a successful businessman, a real one. He ran a legitimate firm, made millions. He wasn't just rich, he was respected. He had more than most people could ever dream of. But even that wasn't enough. Instead of being satisfied, he created a fake investment scheme, lied to investors, and built a giant house of cards. At one point, he was managing billions of dollars in fake profits, and when the truth came out, it all collapsed. He lost everything and spent the rest of his life behind bars, not because he needed more money, but because he wanted more. So what's the lesson here? Housel puts it simply: to risk what you have and need for what you don't have and don't need is foolish. And yet, people do it all the time. Imagine you earn $100,000 a year. You live comfortably. You save a little. You travel every now and then. That's more than most people. You're doing well. But if your coworker earns $200,000, suddenly, your enough doesn't feel like enough anymore. So you work harder, push the limits, take bigger risks, and the cycle keeps going. This is social comparison, and it's everywhere. Your coworker might compare himself to someone making $1 million. That millionaire might compare himself to a hedge fund manager. And the hedge fund guy, he might compare himself to Warren Buffett. And Buffett, he might glance at Elon Musk. See how the ladder never ends? There's always someone above you. And if you keep climbing just to catch up, you may never stop. There's nothing wrong with ambition, because it's very human. But if the goalpost keeps moving, you'll never be happy. You'll always feel behind. That's how social comparison works. It tricks you into thinking you're missing something, even when you're not. So here's the big takeaway from this chapter. Knowing when you have enough is one of the most powerful money skills you can learn. It helps you avoid taking risks that could ruin everything you've already built. When you define your own enough, you stop letting comparison control your life. So the next time you catch yourself chasing more money, more stuff, more approval, stop and ask yourself, do I already have enough to live the life I want? If the answer is yes, maybe the smartest move isn't to speed up, but to slow down, to look around, to realize the view from where you are might already be beautiful. Chapter 4: Confounding Compounding. Let's start with a name you definitely know: Warren Buffett. A legend in the world of money. But here's the part most people don't talk about. Yes, Buffett is a smart investor, but what really made him rich is how long he's been investing. He's been trading stocks since he was just 10 years old, and by the time most people are just learning what a stock is, Buffett had already been growing his money for decades. Now here's the crazy part. More than 90% of Warren Buffett's wealth was made after his 65th birthday. Yes, after age 65. That's not because he found some secret trick late in his life. It's because compounding had finally kicked into higher gear by then. His investments had decades to grow. That's how compounding works. It's not just how much you earn, it's how long you let it grow. Think of compounding like a snowball. You roll a small one down a hill. At first, it's slow. It barely grows. But with each turn, it picks up more snow, then more, then even more. And by the time it reaches the bottom, it's a beast. Not just because of snow, but because of momentum. That's how money grows through compounding. Your savings earn a little interest. Then next year, that interest earns interest. And the cycle keeps going. At first, it looks small, but over time, the growth becomes so big, it feels unbelievable. That's why Housel calls it confounding, because the results are so huge, they don't even seem to make sense at first. But here's the problem. Most people give up too early. They save for a few years and think, this isn't doing much. So they stop. They pull their money out. Or they jump into something faster, shinier, or riskier. But compounding, it's slow. It's all about time. It rewards patience, not perfection, not fancy strategies, just consistency. Let's go back to Warren Buffett again. If he had started investing at age 30 instead of age 10, or if he had retired at 60 instead of continuing into his 90s, would he still be rich? Probably. But would he be Warren Buffett? Definitely not. His real superpower isn't just his skill, it's his time in the game. Buffett isn't just good, he's been good for a very, very long time. So here's the big takeaway from this chapter. The most powerful tool in wealth building isn't luck or brilliance. It's time. It's patience. It's letting the snowball roll. Compounding rewards people who stick with it. Not for weeks, not for months, but for years. Let your money roll like that snowball, because the longer it rolls, the bigger your future gets. Chapter 5: Getting wealthy versus staying wealthy. What's harder, getting rich or staying rich? At first, it sounds like the same game, but Morgan Housel says they're actually two completely different skills. Getting rich, that takes ambition, risks, big swings. It's about attack. It takes guts. You invest in bold ideas. You start businesses. You say yes to chances most people walk away from. But staying rich, that's a different game. It's about defense, survival, caution. It's not about the biggest return anymore. It's about not losing what you've already earned. Morgan tells the story of Jesse Livermore, one of the most famous stock traders of the early 1900s. During the 1929 market crash, while most people lost everything, he made billions of dollars by betting against the market. He was a legend, confident, feared, respected. But here's what happened next. He didn't stop, didn't shift gears, didn't protect what he built. Instead, he made bigger and riskier bets, and he lost everything, all of it. That's the danger of not knowing when to shift gears from building to protecting. So what's the lesson here? It's this. Success is a lousy teacher. It seduces smart people into thinking they can't lose. Imagine this. You build a beautiful house, brick by brick. Blood, sweat, and savings. It takes you years. Would you light fireworks inside it? Would you leave the doors wide open in a storm? Of course not. But that's what some people do with their money. They gamble with what they've worked so hard to create, chasing more than they'll ever need. So, what does it take to stay wealthy? Morgan says it comes down to 3 traits. Number 1, frugality, living below your means, even when you can afford more. Number 2, humility, knowing you're not invincible. Markets can change, so can your luck. Number 3, a healthy dose of fear, not the kind that paralyzes you, but just enough to keep you from making reckless moves. Because you can spend your life building wealth and lose it in one bad bet. You can build a fortune in years and watch it disappear in minutes. That's why staying rich matters just as much, if not more, than getting there. So here's the big takeaway from this chapter. Getting rich and staying rich are 2 different games, and you need to master both. Getting rich takes bravery. Staying rich takes caution. It's about balance, knowing when to sprint and when to slow down, knowing when to chase the next big thing and when to protect the good thing you already have. Because sometimes the smartest move isn't to go faster, it's to pause, breathe, and say, I've built something worth keeping, and I'm not going to risk it just for more. So take smart risks. But when you've built something worth keeping, make sure you hold on to it. Build bold. Protect wisely. That's the real wealth strategy. Chapter 6. Tails, you win. Let's start with a simple truth. Most things don't work out. In business, investing, and life in general, ideas fail, projects flop, plans fall apart, people let you down. And that's how life is. But every now and then, something clicks. And when it does, that one win can make up for everything else. Housel calls these rare wins tail events. The kind of events that may be rare, but have a massive impact when they do happen. Take Apple, for example. They've released hundreds of products over the years. Some were okay, some totally flopped. But then came the iPhone, and it completely changed the company's future. Apple went from just another tech brand to one of the biggest companies in the world, not because everything they did worked, but because one thing did. The other products, they played their part, but none came close to the impact of the iPhone. That's the power of a tail event, and this doesn't just happen to giant companies. It happens in real life too. Your life. Think about it. One new friend changed your whole social circle. One job offer led to a brand new career. One move to a new city totally changed your path. Those are your tail events. Maybe 95% of what you tried didn't work. But that 5%, that job, that idea, that person, it made all the difference. So what's the lesson here? Housel puts it simply. Don't expect every effort to pay off. In fact, expect most things to fail, and be okay with that. That's how the process works. What matters is that you keep trying, you keep exploring, you keep showing up. So when that one rare moment comes, you're ready. But the problem is, people give up too soon. They try something once or twice. It doesn't work. They quit. They think, maybe I'm just not cut out for this. But here's how people become successful. At first, they fail, over and over again. And then, boom, one moment hits. One idea works. One tail event shows up. And suddenly, they're not a failure anymore. They're a genius. Let's take a quick example from sports. Michael Jordan missed over 9,000 shots in his career, lost almost 300 games, failed to make the game-winning shot 26 times, and yet, He's remembered as one of the greatest basketball players of all time. Why? Because he stayed in the game long enough for his tail events to happen. Success doesn't come from being perfect. It comes from not quitting before your tail event happens. So here's the big takeaway from this chapter. Most of your success will come from just a few key moments. You don't need to win all the time. You just need to win big every now and then. Don't let small failures take you out, because your next big win could be just around the corner. So be patient, take smart risks, try new things, learn from the misses, and most importantly, stay in the game. Because when the moment comes, when life flips the coin just right, tails, you win. Chapter 7. Freedom. Imagine this. You wake up when your body says it's time, not your alarm. You stretch. You take your time with breakfast. Maybe you go for a walk, read, or just sit and think. And the best part? No one is rushing you. No one owns your schedule. That is freedom. Now compare that to how your most days actually feel. Waking up to an alarm, rushing through traffic, days that don't feel like yours. That contrast between what you want and what you live, that's what this chapter is all about. Let's start with a question. If someone handed you $1 million right now, no strings attached, what would you do with it? Buy a mansion? A luxury car? Book a dream vacation? Sure, those things sound amazing. But here's what Morgan Housel wants you to understand. The most valuable thing money can buy isn't stuff, it's control. It's the power to say, I'll do what I want, when I want, with whom I want, for as long as I want. Think about this. Why do people dream about retiring early? Why is remote work so popular? Why do millions of people want to be their own boss? It's not just about earning more money. It's about owning more of their day. It's about freedom. The freedom to nap in the afternoon. The freedom to turn off your phone and no one panics. The freedom to say no to what doesn't matter and yes to what does. Think about it. What would your days look like if you had total freedom over your time? That image is your real financial goal. Not having the most money, not having the most stuff, not chasing status, not showing off, just choice. The choice to work less. The choice to walk away from what doesn't feel right. The choice to spend your day how you want, not how someone else demands. Here's a moment from Morgan's own life. He once asked a wealthy friend, "What's your ultimate financial goal?" And the friend didn't say a yacht or a luxury car. He said, "I want to wake up every day and say, I can do whatever I want today. No schedule, no boss, no pressure." And that feeling, that is real wealth. So here's the big takeaway from this chapter. The real goal of money isn't to look rich. It's to buy time. The time you control, the time you can't get back. Chapter 8. Man in the Car Paradox. Ever seen someone in a brand new luxury car and thought, wow, that person must be incredible? Be honest, we've all had that thought. But here's the surprising part. According to Morgan Housel, the person driving that car doesn't get the admiration they think they're getting. Why? Because most people aren't thinking about them. They're imagining themselves driving that car. And chances are, you've done it too. That disconnect between what we think others are admiring and what's actually happening, that's what Morgan calls man in the car paradox. And once you understand it, it'll totally shift how you think about wealth, success, and how people actually see you. Let's dig into it. We believe a big house, a fancy car, or expensive clothes will earn us admiration. But in reality, the admiration doesn't go to the person who owns the thing. It goes to the thing itself. And that's the problem. Because so many people spend money on things, not just because they want them, but because they want to be seen in a certain way. They think, if I wear this, drive this, live here, people will think I've made it. people will respect me more. But according to Housel, people don't admire you as much as you think. Most of the time, they're too busy thinking about themselves. We overestimate how much people notice or care about what we wear, drive, or own. Because truthfully, we all spend way more time thinking about ourselves than others. Let's say you walk into a room wearing a designer jacket. You're hoping people will think, wow, that person is successful. But what they're really thinking is, could I pull off that look? Would I ever wear that? Would that look good on me? They're not admiring you. They're running a mental slideshow about their own life. And this mindset, it shows up on social media too. We post pictures of vacations, new gadgets, luxury dinners, thinking people are gonna love this. But most people, they're just scrolling, comparing, daydreaming, wondering if they could ever have what you're showing off. It's not about you, it's about them. And it's not wrong, it's just human nature. So here's the big takeaway from this chapter. Trying to impress people with money usually backfires. If you want true respect, focus less on showing off what you have and more on being someone worth admiring. The most admired people usually aren't the ones trying to be admired at all. They're kind, they're humble, they treat others well. And that's what earns real respect. Not the car, not the jacket, not the curated Instagram feed. Be someone worth admiring, not someone worth envying. Chapter 9. Wealth is what you don't see. When you think of someone wealthy, what do you picture? A mansion on a hill? A Ferrari pulling into the driveway? A wristwatch that costs more than your car? It seems obvious, but here's the twist. Those things don't actually show wealth. They show how much wealth was spent. In other words, the real sign of wealth isn't what people show off. It's what they don't. And that's what this chapter is all about. Let's dive in. Most people confuse wealth with richness. They see someone spending a lot of money and assume they do have a lot of money. But in reality, wealth isn't about what you buy. It's about what you keep. It's not an expensive car or the big vacation. It's the money sitting quietly in a savings account or growing inside an investment portfolio. Wealth is invisible. Let's say someone buys a $10,000 watch. You see the sparkle, the brand, the attention it gets, and you think, that person must be doing really well. But what you are actually seeing is $10,000 gone, spent, used up, not saved, not invested, no longer growing. That money isn't working for them anymore. It's sitting on their wrist. Now compare that to someone who wears a basic $50 watch, but quietly has hundreds of thousands of dollars invested. Now ask yourself, who's actually wealthier? Exactly. It's the one you'd never even suspect. Here's the trap most people fall into. We think spending is proof of success, but often, spending is just proof that you had money, and now you don't. We show off the new car, the vacation, the fancy dinner. But Morgan reminds us, spending money to show people how much money you have is the fastest way to have less of it. Because real wealth, the kind that creates freedom, peace of mind, and security, is often completely invisible. It's not about showing off. It's about building something solid behind the scenes. Let's say your neighbor gets a brand new SUV, top of the line, shiny, sleek, loud. Looks impressive, right? But maybe they're buried in debt. Maybe that car loan is eating half their paycheck. Now across the street, another neighbor drives a 10-year-old Honda. No upgrades, no attention. But they're debt-free. They've been saving and investing for years. And if they lost their job tomorrow, they'd be fine. You'd never guess. But they have real financial strength. Social media makes this even trickier. We post the new shoes, the expensive meal, the weekend getaway. But when's the last time someone posted their savings account, their investment portfolio, the mortgage they just paid off? But why not? Because true wealth doesn't get likes. But guess what? Those are the real flex. Not the stuff you show off, but the quiet decisions that build true financial security. Because every time we trade dollars for impressions, we're giving away what could have been freedom. So here's the big takeaway from this chapter. Wealth is what you don't spend. It's savings, it's investments, it's security and freedom, not stuff. And the strongest kind of wealth? You'll never even notice it, because it's working silently, behind the scenes. Chapter 10. Save money. We're usually taught to save for specific things. A house, a car, a vacation. And those are all good reasons. But Housel says, that kind of saving can be too narrow. Because life, it's unpredictable. It doesn't follow a script. Let's say your car breaks down, or you lose your job suddenly, or a once-in-a-lifetime opportunity shows up and you want to grab it. And if all your money is tied to a single purpose, you don't have the flexibility to adapt. But if you've been saving, not for a thing, but just because, then you're ready. You don't have to panic. You don't have to borrow. You don't have to miss out. You just act with confidence. That's the power of saving without a reason. It gives you flexibility. It gives you time. It gives you space. And it gives you something most people crave, but rarely have. Control. Control over how you respond. Control over what you walk away from. Control over what you walk toward. And Morgan puts it simply, saving without a specific goal isn't pointless. It's powerful. It's the money that says, you'll be okay, not because you've predicted the future, but because you've prepared for it. Think of saving money like building yourself a safety net, not because you're planning to fall, but because life doesn't ask before it throws you off balance. So here's the big takeaway from this chapter. Save money, even when you don't have a reason to. Save because it gives you options, because it gives you peace of mind, because it puts you in control when life throws you a curveball. Save because when the unexpected happens, and it always does, you'll be ready. Not scrambling, not stuck, but steady and in charge. Chapter 11. Reasonable greater than rational. This chapter explains why being reasonable, meaning doing what makes sense for you, even if it's not mathematically perfect, is often better than being perfectly rational. Let's start with what rational really means. To be rational is to make decisions that give you the highest possible returns. It's the kind of thinking economists love. It's the textbook way to handle money. But here's the problem. We're not robots. We're humans, with emotions, with goals, and with different definitions of what success even means. That's why being reasonable can sometimes be the smarter choice, even if it's not mathematically perfect. Let's say you have a mortgage with a super low interest rate. Technically, a rational person might say, don't pay it off early, invest that money instead. That would be the rational move. But maybe that debt keeps you up at night. Maybe it feels like a weight on your chest. Maybe you feel safer being 100% debt-free, so you pay it off anyway. That's not irrational, that's reasonable, and that matters. Morgan puts it like this: the best financial plan isn't the one that looks perfect on paper. It's the one you can stick to for years. Because if a plan that looks great on a spreadsheet, but stresses you out in real life, you probably won't stick to it. But a good enough plan you feel good about, you'll stick with it. And that's what really matters. Think of it like working out. Sure, the perfect workout plan might be the one backed by science and data, but if it's too strict, too intense, or too complicated, you'll quit. A good enough plan that fits your lifestyle, that's the one that works. The same goes for money. You don't need a perfect financial plan. You need a plan that makes sense for you. Maybe you keep more cash than experts recommend. Maybe you invest a little more conservatively. Maybe you stick with a simple strategy. But if that helps you sleep better, stay consistent, and stay in the game for decades, that's a great plan. So here's the big takeaway from this chapter. It's okay, even smart, to let emotion play a role in your financial decisions. Because at the end of the day, money isn't just about numbers. It's about feelings. It's about what gives you peace of mind. Don't chase perfection. Aim to be consistent. Aim to be calm. Aim to be reasonable. Chapter 12. Surprise. The builders of the Fukushima nuclear plant weren't stupid. They were some of the best in the world. They built a seawall designed to withstand the biggest tsunami Japan had ever seen. They thought they were being safe. But when the 2011 tsunami hit, it didn't care about their history books. It was bigger, faster, and deadlier than anything on record. The plant didn't fail because of a wave they knew about. It failed because they weren't humble enough to prepare for a surprise. And that surprise is what this chapter is all about. Let's dive in. Stanford professor Scott Sagan has a quote that everyone who follows the economy or investment markets needs to hang on their wall. Things that have never happened before happen all the time. Think about 9/11. It was a single tragic morning that no analyst saw coming. But look at the dominoes it tipped. Because of 9/11, fear gripped the world. To prevent a total economic collapse, the Federal Reserve did the only thing it could. It slashed interest rates. And suddenly, money became dirt cheap. That cheap money fueled a massive housing frenzy where people who couldn't afford a studio apartment were buying 3-bedroom suburban homes. And in 2008, that bubble didn't just leak, it exploded, leading to the Great Recession. Millions of people lost their jobs overnight. Desperate and unemployed, they did the only thing they thought would save them. They took massive student loans and went back to universities to upskill themselves. And that is how a terrorist attack in 2001 fueled the student loan boom so many years later. It sounds like a conspiracy theory, but it's just the math of tail events. A few unpredictable black swans drive almost everything that matters to your bank account. History is full of these surprise events that nobody predicted, but everyone felt. But surprises aren't always tragedies. Sometimes, they are the engines of the greatest wealth ever created. Think about the pillars of the modern world. The internet, blockchain, AI. Almost no one in the financial world saw their economic impact coming. But they didn't just happen, they reshaped the entire global economy. Even Benjamin Graham, the greatest of all time in investing and mentor to Warren Buffett, knew we shouldn't use history as a map of the future. Graham wrote The Intelligent Investor, the literal Bible of the stock market. It was full of step-by-step formulas to get rich. But here's the truth. If you use those formulas today, quite frankly, you'll go broke. Why? Because the world has changed. And more importantly, his secret got out. In business, finance, and real life as well. As soon as a pattern is discovered, it is traded away. History is a record of what worked, until too many people tried to do it. Think of it like a secret shortcut on Google Maps. If you're the only one who knows it, you save 20 minutes. But once everyone reads the same book and uses the same shortcut, it becomes another traffic jam. That's why Graham himself updated his book several times. And each time, he actually threw out his old formulas and replaced them. He told people, these don't work anymore because the world is different now. And he was right, because the further you look back in history, the less likely you are to find specific trends that still work today. Think about how much the world has evolved in just a few decades. Industries have shifted from steel and oil to software and attention. Venture capital, the money that built companies like Google, was barely a thing. Even the stock market itself looks different. There were almost no technology stocks in the main index. But today, they run the show. And if you use a map from the last century to drive through the present world, you're going to get lost. So here's the big takeaway from this chapter. Never assume the worst thing that has ever happened is the worst thing that could ever happen. Because every worst-case event in history was a surprise when it happened. So don't look at the Great Depression and say, that's the worst it can get. Look at it and say, I have no idea how crazy things are going to get next. Also, If you are waiting for history to give you permission to invest in the next big thing, you've already lost. Because the biggest gains don't come from following the map. They come from the territory history hasn't even discovered yet. Chapter 13. Room for Error. Let's start with a simple truth. Life rarely goes according to plan. Surprises happen. Mistakes happen. And when they do, people who thrive aren't the ones with perfect predictions. They're the ones who left room for error. And that's what this chapter is all about. Let's dive in. Let's say you're planning for retirement. You look at market averages, past returns, and typical inflation rates. Seems smart, right? But if you don't leave some room for unexpected stuff, like a sudden illness, job loss, or market crash, your perfect plan can fall apart. Not because you made a bad decision, but because you built a plan that only worked if nothing went wrong. And that's the danger. So what's the lesson here? Housel puts it simply. If your financial plan doesn't make room for surprises, it's not a real plan. It's a fantasy. The future is full of surprises. You can't predict them, but you can prepare. Plan with confidence, but leave room for chaos. So that when the unexpected comes, and it will, you'll be standing and ready to move forward. That's the power of room for error. It gives you breathing space when life doesn't follow the script. Even the smartest investors, the best business leaders, the most careful planners, get hit with bad luck sometimes. But what separates them from the rest is they left space. They built slack. They didn't chase perfection. They planned for chaos. That's not fear. That's life. So here's the big takeaway from this chapter. If your budget, your savings, or your investment plan only works when everything goes right, you're just one bump away from trouble. Room for error isn't a backup plan. It's the foundation of every strong financial strategy. Save more than you think you need. Expect some bumps in the road. Always plan for things not to go according to plan. Not because you're scared, but because life doesn't follow scripts. It throws curveballs. Chapter 14. You'll change. Have you ever looked at your old social media post and thought, I can't believe I used to think that way? Or maybe you saved up for something you thought you really wanted, only to realize later you didn't care about it anymore. Or just think back to who you were 5 years ago. What music did you love? What were your goals? What did you believe about success? Now, how many of those things are still true today? Chances are, a lot has changed. And yet, we make decisions, sometimes big ones, based on who we are right now, forgetting that future you might want something totally different. And that's what this chapter is all about. Let's get into it. We make all kinds of plans: careers, savings, retirement. And when we do, we usually assume one big thing, that the person we are right now will be the same in 10, 20, or 30 years. But here's the truth. People change. You will change. And that change, it's hard to predict, and even harder to plan for. Morgan Housel calls it the end of history illusion. It means we understand how much we've changed in the past, but we somehow assume we'll stay the same from here forward. And that assumption, it's a problem, because it leads us to make rigid long-term plans for a future version of ourselves we don't even know yet. Let's say you're 25, and you start planning and dreaming about what you'll want at 55. Retirement on a beach, a fancy car, maybe a home spa. But here's the catch. That 55-year-old version of you might want totally different things. Like, not a beach house, but time with grandkids. Not luxury, but peace. Not more stuff, but more meaning. So if your plan only fits who you are today, future you might feel trapped in a life that doesn't fit you anymore. Housel isn't saying don't plan. He's saying your plans should have flexibility built in. Don't assume you'll always want what you want now. Leave space to change your mind, to shift directions, to grow. If you acknowledge that your goals, interests, and values will probably shift, you give yourself the power to adapt. You don't have to get it all perfectly right today. You just have to leave room to adjust. Because the person you'll be in 5, 10, or 20 years is a stranger you haven't even met yet. This is why chasing big, flashy goals just because they look good today can backfire. That dream car, that massive house, they might not matter to you in 10 years. And if you spent years chasing them, only to realize they don't make you happy, that's a hard pill to swallow. So here's the big takeaway from this chapter. You're going to change. The person you are today won't be the same in the future. And that's not a problem. That's human. So make financial plans that are strong, but don't lock yourself into a life path that can't evolve with you. Create a financial life that's strong enough to support you now and flexible enough to support whoever you become later. Build space for growth. Make peace with change. Because the best financial plan is one that's ready to serve the future version of you, even if you haven't met him yet. Chapter 15. Nothing's free. Morgan Housel says, when it comes to money, like most things in life, nothing is free. But the price you pay doesn't always show up on a price tag. Sometimes it comes as stress. Sometimes there is uncertainty. And sometimes it demands patience. And in this chapter, we'll talk about why recognizing and being willing to pay those hidden prices is actually the secret to build long-term wealth. Let's start with how we usually think about cost. When we think about cost, we usually picture money bills. We go to a movie, we pay for the ticket. We go to dinner, we pay the bill. But when it comes to investing or building wealth, the price is different. Instead of paying with money, you pay with doubt. You pay with emotional ups and downs. And most people, they don't see that part coming. Let's take investing in the stock market, for example. There's no upfront fee just to invest. But the real cost? It's the stress of watching your portfolio drop. It's staying calm during a recession. It's holding steady when everyone else is panicking. It's the anxiety of not knowing what comes next. That's the price of building long-term wealth. And if you're not ready to pay that price, you might cash out right before your biggest gains. So next time when the market dips or your progress feels frustrating, remind yourself, this is just the fee. Because that fee, it's the toll you have to pay to cross the bridge to financial freedom. And once you see it that way, you stop panicking. Because you know, it's just a part of the deal. You're not off course. You're just paying the price that success demands. So here's the big takeaway from this chapter. Nothing in life is free, especially not success. Whether it's building wealth, growing investments, or chasing your goals, there's always a price. But the price isn't always money. Sometimes it's discomfort. Sometimes it's fear. And sometimes it's staying on the course when things get tough. Volatility, risk, and uncertainty aren't signs of something going wrong. They're the price of being in the game. Chapter 16. You and me. Why is it that one person panics and sells everything during a market crash, while someone else just sips their coffee and keeps on investing? Or why your friend is all in on crypto, while you're just focused on keeping things simple? Well, Morgan has an answer. It's because we're all playing different financial games. And when you compare yourself to others, without understanding their goals or timelines, it can lead you off your own financial path. Imagine you're running a marathon. You've trained. You have a plan. You're pacing yourself. But suddenly, someone sprints past you. Do you chase them? Of course not. Because you don't know if they're running a 5K or just sprinting to the water station. If you follow them, you'll burn out long before your race is over. It's the same with money. Everyone handles money differently because they have different goals, different timelines, and different rules. Some people are day trading to make a quick buck, while others are investing for the next 30 years. Some are building generational wealth, while others just want to retire early. That's why copying someone else's strategy, without knowing their goals, can be dangerous. Social media makes this even harder. You scroll through Instagram and see someone retired early, someone just bought their dream home at 25, someone made 6 figures in one stock trade, and you start thinking, am I falling behind? But what you don't see, the risks they took, the debts they carry, the failed trades they don't post about. And when you compare your life to someone else's short-term win, you might end up making a decision that feels good now, but hurts you later. It's like wearing their shoes to run your race, but they might just not fit. So before you follow someone's advice, or try to match their results, ask yourself, are we even playing the same game? Because if you're not, their strategy might win for them, but it could set you up for failure. So here's the big takeaway from this chapter. Don't let someone else's choices distract you from your own plan. Don't compare your pace to someone else's sprint. Don't chase a goal that doesn't match your life. Instead, define your game, understand your plan, and play to your strengths. Because true financial success, it's not about beating others. It's about staying in the game long enough to win your own version of it. Chapter 17. The Seduction of Pessimism. Ever notice how your ears jump to life when someone says, the market's about to crash, or the economy won't survive the next 5 years? What's your reaction? Do you stop and pay attention? Well, most people do. In this chapter, Morgan explains why we're drawn to negative predictions, and why, in the world of money, that mindset can actually hold you back. Let's start with a basic truth about human nature. Bad news grabs attention, and good news, it gets ignored. When someone says, things will be okay, you nod and move on. But when someone says, a disaster is coming, you stop, you listen, you prepare, you worry. Why? Because pessimism feels smart. It feels urgent, like an alarm going off. For example, let's say 2 headlines pop up. One says, markets expected to rise steadily over the next decade. The other says, crash coming, protect your savings before it's too late. Which one are you more likely to read? Exactly, the scary one. Why? Because fear gets your attention. It feels like you're getting a secret heads up before disaster strikes. But here's what Morgan wants us to understand. In the world of money, optimism is usually more accurate, especially over the long run. Think about how much progress we've made. Global poverty, down. Life expectancy, up. Technology, growing faster than ever. The stock market, bumpy. Yes, but it trends upward over time. Yes, there are setbacks. There are crashes, recessions. But over the long term, progress is the trend. So why does pessimism sound more intelligent? Because it feels like protection. When someone says, be careful, they sound wise, thoughtful, like they've seen things you haven't. But Morgan reminds us, yes, pessimism often sounds smarter, but optimism is what leads to long-term success, especially in investing. That's why the people who succeed with money are usually the ones who stay invested, even when it's scary, keep saving, even when the news says not to, keep building, while others are backing away. They're not ignoring risk, they're just not ruled by it. Let's be clear here. It's okay to be careful. It's wise to prepare. But when fear makes all your decisions, you end up missing the very chances that could move you forward. You sell at the bottom. You avoid investing. You sit on the sidelines. And over time, that fear costs more than any crash ever could. So, how do you stay optimistic in a world that loves bad news? You zoom out. You look at history. You remember the bigger picture. Yes, bad things happen. But over time, good things keep growing. Innovation continues. Businesses rebuild. Markets recover. Progress is the trend, not the exception. So here's the big takeaway from this chapter. Don't let pessimism seduce you. It might sound smart. It might sound safe. But in the world of money, real growth lives on the side of optimism. And if you let fear guide your every choice, you might miss out on the best opportunities. So, stay grounded, prepare for bumps, but keep moving forward. Because if history has taught us anything, it's this. Over time, things tend to get better, even if it takes a while. Chapter 18, When You'll Believe Anything. In this chapter, we'll talk about why, when it comes to money, we're often guided more by stories than by facts. Stories we hear, stories we see, and most powerfully, stories we believe. Let's break it down. Let's say your friend gets rich off crypto. They tell you how they bought low, sold high, and now they're driving a Tesla. You hear their story, you see their success, and suddenly you feel like you should do it too. But pause for a second. Did you believe it because it was logical or because it was emotional? You hear the highlight reel, but what you didn't hear is the sleepless nights when prices crashed, the credit card debt they took to invest, the moment they almost sold everything and didn't, or the fact that they just got lucky. Their story sounds clean, but the reality is way more complicated. That's why Morgan warns us. Just because a story feels true doesn't mean it is. Yes, our brains are wired to understand the world through stories, because stories are easier to remember, easier to share, and much easier to believe. But we have to be extra careful not to confuse a good story with a good strategy, because stories are simplified, and real life, it's messy, it's complicated, it's full of unknowns. So the next time someone shares their sure thing success story, pause, ask questions, check the facts, and remind yourself, a good story isn't always a good plan, because chasing someone else's story might lead you far off your own path. So here's the big takeaway from this chapter. Be careful what financial stories you believe. They might be inspiring, they might be popular, but they're not always completely true, and they're not always right for you. Stories are powerful, they move us, they motivate us, but they're not facts, they're not guarantees, and they're not an alternative to a solid plan. Inspiration is valuable, but it's not a substitute for doing your homework. Chapter 19, All Together Now. If you've made it this far, first of all, congratulations. That means you're not just curious about money, you're serious about understanding it. Not just the math part, but the human side of it. The emotions, the habits, the real life stuff that numbers can't explain. Now, in this chapter, Morgan wraps everything up and shares the biggest lessons we've learned so far in the entire book. But before we dive into the actual lessons, let's listen to a strange but true story that Morgan shares. It's about a dentist visit gone horribly wrong. It's 1931. A man named Clarence Hughes walks into a dentist's office. He's in pain. His mouth hurts badly. So the dentist gives him anesthesia and puts him to sleep. But when Clarence wakes up, 16 of his teeth gone. His tonsils also gone. And a week later, he died of complications. His wife sues the dentist, not because the surgery failed, but because Clarence never agreed to it in the first place. But back then, doctors didn't need permission. The thinking was, doctors know the best. Patients didn't get a say. But that thinking has changed now, because over time, the medical world realized something powerful. People are different. What works for one person may not work for another. So today, doctors share the options, and patients decide what's right for them. Morgan brings up this story to make a point. He says, I can't tell you what to do with your money, because I don't know you. I don't know what you want, when you want, or why you want it. So any advice I give without knowing you, it would be like that dentist pulling teeth without asking. It might work sometimes, but it's risky and not respectful of your unique situation. But that also doesn't mean advice is useless, because just like doctors know what usually works, there are universal money truths. You just need to apply them in a way that fits you. So here they are. Morgan's key lessons from this book. Simple, powerful, real, and easy to remember. Lesson 1. Stay humble when things go well, and be forgiving when they don't. Nothing is ever as great or as terrible as it seems. Luck and risk are real. You can't see them, but they shape everything. Respect that, and you'll make better decisions. Lesson 2. Less ego, more wealth. Wealth isn't what you show off, it's what you don't. It's the money you save by saying no to something today, so you can have more options tomorrow. Lesson 3. Manage your money so you can sleep at night. Chasing the highest returns is not worth it. Not if it robs you of sleep. Real success? It's peace of mind. Lesson 4. Time is your secret weapon. Think of money like planting a tree. You don't dig it up every day to check it. You water it, and you wait. Time makes it grow. Give your money a room to grow, and it will surprise you. Lesson 5. Be okay with things going wrong. Even the smartest people mess up. That's normal. One bad chapter doesn't ruin the whole book. A few great decisions often make up for a lot of bad ones. Lesson 6. Buy time, not stuff. A big house is nice. A cool car is fun, but you could trade all that stuff for more time with your kids, for a slow morning walk, for saying no to what you don't love. That's what real wealth buys. Freedom. Lesson 7. Be kind, not flashy. A fancy car might turn heads, but kindness and humility, they win hearts, and that lasts longer. Lesson 8. Save just because. You don't need a reason. Save for the unknown, because life loves to surprise us, usually when we least expect it. Savings give you confidence and security. It's like an umbrella. You don't wait for the rain to buy one. Lesson 9. Success has a cost. Be ready to pay it. Stress, doubt, fear. These are the prices of success. Every dream has a toll booth. Don't fear the toll. Just know it's a part of the road. And yes, it's worth the ride. Lesson 10. Leave room for error. Always have a margin of safety, because things rarely go exactly as planned. No plan is perfect. Stuff goes wrong. Life gets weird. So build a cushion. Safety nets aren't weaknesses, they're wise. Lesson 11. Avoid extremes. Going all in can backfire. Life changes. You change. What felt smart 5 years ago might feel reckless today. So be flexible and ready to adapt. Lesson 12. Love risk, but fear ruin. Risk is necessary because it brings rewards, but ruin, it ends the game. So take smart risks, but avoid anything that could wipe you out. Lesson 13. Know your goal. Are you saving for retirement? Trying to buy a house? Or building generational wealth? Know your game, and don't let people playing a different game influence your decisions. Your money, your goals, your game. And finally, lesson 14. Respect the mess. Money is messy. It's personal. It's emotional. And people will always see it differently, because people have different dreams, different goals, different fears. And that's okay, because what works for you? That's the big question. There's no one right way. There's just your way, the one that fits your life, your values, and your goals. Now that you've heard all the key takeaways, next, it all gets personal. In the final chapter, Morgan opens his personal vault and reveals exactly how he manages his own money, how he applies these lessons to his own life, the choices he makes, the trade-offs he accepts. Curious to know what a finance expert actually does with his own wealth? The next chapter reveals it all. It's raw. It's honest. You don't want to miss it. Chapter 20. Confessions. This is one of the most personal and eye-opening chapters of this book. It's not just about money strategies. It's about what Morgan himself does with his own money. And more importantly, it's about why he does what he does. Let's start with a simple question. What do you own and why? This is the question billionaire investor Sandy Gottesman used to ask people he wanted to hire, because it cuts through the talk and gets to the truth. And it turns out, a lot of people say one thing about money, but do something completely different when it's their own money on the line. Half of the mutual fund managers don't invest in their own funds. That's like a chef who won't eat their own cooking. And doctors? Same thing. They recommend one treatment to their patients, but choose something totally different for themselves. So what's going on? It shows us something important. When it's your money or your life is on the line, we make decisions differently. Now let's talk about how Morgan handles his own money. His biggest money goal? Independence. It's not about having the biggest house or fanciest car. It's about being in control of his time. It's about having the freedom to live life on his own terms. Morgan learned this from his dad. His father became a doctor at 40 with 3 kids. He went from being poor to doing okay, but even when things got better, he kept saving by living below their means. He saved a lot. And one day, after years of high-stress work in the emergency room, his dad just quit, walked away, free from everything. That left a mark on Morgan. It stuck with him for life. For him, that freedom to do what he wants, when he wants, with whom he wants, became the ultimate financial goal from then on. And you don't need to be a doctor or make a ton of money to get there. You just need to keep your lifestyle expectations in check and save like it matters. Morgan and his wife have a simple rule. Don't let your lifestyle grow just because your income does. They started off with simple jobs, a basic apartment, an okay car, nothing fancy. They liked reading, walking, and spending time together, stuff that doesn't cost much. And even after their incomes went up, they kept the same lifestyle. They didn't feel like they were missing out because they figured out early on what was enough for them, and they stopped moving the goalpost. That allowed them to save more and more over time. And the result? It gave them something better than more stuff, which is more control, more independence, and less pressure. Now here's something that might surprise you. Morgan and his wife paid off their house early, even though interest rates were super low and the math screamed, you should be investing that money. But for them, it wasn't about the math, it was about peace of mind. They didn't want to owe anyone money. Owning their home outright made them feel free. No monthly payments, no debt. It wasn't the right financial decision, but it was the right emotional decision. And that's worth more than a few extra dollars in returns. Because sometimes being happy is more important than being right. Now here's another thing they do. They keep around 20% of their assets in cash. Most financial experts would say that's way too much. But here's their thinking. Cash is like oxygen for their lifestyle. It lets them breathe when life gets hard. An unexpected medical bill, job loss, or whatever emergency pops up. They don't have to panic. They don't have to sell their stocks at the wrong time. And most of all, holding cash gives their investments more time to grow without being interrupted. Now here's how Morgan invests. He started his career picking individual stocks, and at one point, he held shares of 25 different companies. But these days, he keeps things simple. He invests in low-cost index funds, both US and international. He still respects people who actively pick stocks, but for him, it's not worth the extra risk. He knows he might not beat the market, but he also knows he probably won't mess things up, and that's a trade he's happy to make. His family lives simply. They save a lot, and they invest steadily. Their plan is simple. Invest from every paycheck. Max out retirement accounts. Contribute to kids' college funds. And let the money grow quietly over time. Nothing flashy. No chasing trends. No fancy strategies. Just patience, optimism, and consistency. So here's the big takeaway from this chapter. Personal finance is exactly that, personal. What works for one person might not work for the other. So whether it's paying off your house early, keeping extra cash, or sticking with simple investments, do what gives you peace of mind. Because when it comes to money, no one is crazy. We're all just trying to do our best with what we've got, where we are, and who we are.